Good evening, everyone. Welcome to the April Open Lecture at the Asia Pacific Centre for Sustainable Enterprise. My name is Jeremy Williams. I'm the Director of APCSE, and I would like to acknowledge, before we start, the traditional custodians of the land on which we are meeting tonight. I would like to pay my respect to the elders past and present and extend that respect to other Indigenous Australians who are here today. Tonight I have great pleasure in introducing you to my colleague, Associate Professor Jason West from the Griffith Business School. And Jason has just published a book this year in January. It came out, Jason? Right, it's available on Amazon.com, I'm told. Greenleaf publishing this book. And coincidentally, the title of this book is The Long Hedge, Preserving Organisational Value Through Climate Change Adaptation. And I thought it would be a good idea to invite Jason along to our open lecture series to talk about this book. And I think it fits very nicely indeed with the kinds of things that we talk about in the open lecture series at the Asia Pacific Centre for Sustainable Enterprise. So Jason is going to talk for about 45 minutes, he says, so we've got plenty of time for questions afterwards. And I'll hand you over. One last thing, of course, I'll just point out that tonight's hashtag for you tweeters out there is hashtag adaptation. Thank you. Slip of the tongue.
Thanks, Jeremy. Everyone can hear me okay? That's fine? Great. Thank you for the opportunity to come and talk to you tonight about adaptation. In my previous life, I was an executive at, I worked at BHP Billiton in their energy space. So I was looking after energy coal, we're digging it up and making lots of money. And then we got interested in emissions and emissions trading and how can we offset some of these things that we're selling abroad in some sense. So that was my first kind of introduction into mitigation, and then since then I've been landed in this world of adaptation, looking at, well, what happens if we can't mitigate, what do we do next? I guess these are two pictures of things that may occur. The one on the left is after Katrina, and the one on the right is a drag line at Ensham Mine in central Queensland, and those things are massive. They're 4,000 tonnes, really, really high, and that's about 60 metres of water just running through a coal mine in the floods in 2011. So the topic of this is looking specifically at what adaptation is versus what mitigation is. And this is a difficult thing for a lot of executives, especially in the corporate world, to try and grasp, because they're totally separate, and one's a noisy field of inquiry at the moment and the other one's relatively quiet. So what do I mean by this? I guess a simple example is easy here in order to try and delineate between the two. So in 2011, Ford Motor Corporation were buying palladium, which they use in their exhaust systems for the catalytic conversion of the gases that come out of the engines that they were building. And so what happened was that the R&D team were working independently to the procurement team in solving this problem of palladium. Palladium was getting more expensive. The largest mine was in Russia. They weren't exporting as much. So Ford started buying palladium from all other sources, all other stockpiles around the world, and stockpiling it in their office in Detroit. Not their office, but a warehouse in Detroit. And so leading up to about 2011, they started buying palladium, and not off the spot market. So this is just the spot price, but it gives you an indication of where the price trend was leading. They were buying it at whatever contract price they could get it at, and stockpiling it so that they would have a guaranteed security of supply for use in their vehicles for the next 10 years or so. Independent of that, the research and development team knew this was going on, knew that there would be a long-term problem in palladium. And so they looked at different ways of creating new alloys to put in those exhaust systems so that they wouldn't have to use palladium, which was sourced from a single seller. So what happened was that they were acquiring a long position in palladium at the top of the market and then selling that at the bottom of the market because they realised they had too much. The R&D team had solved their problem for them. The procurement division were mitigating the problem. The R&D division were adapting to the problem. And that's the big difference. And the corporate world gets this wrong, not only in regards to emissions, but in everything, okay? We often get it wrong. How do we actually solve this problem? We've got 2 divisions, 3, 4, several divisions in a company, all acting at cross purposes, but seemingly in competition with each other to try and get the best outcome. From a whole of corporate perspective, often those divisions work against each other, and it's a bit tough to get them to talk to each other. So mitigation and adaptation are completely, seemingly, especially in the corporate world, fairly separate things. The problem is for most corporates is that the business community is fairly well aware of the risks and the opportunities associated with mitigation, and they're trading, they're active in it, they're looking at ways of mitigating themselves, etc. But in the form of adaptation, what the true exposures are if we can't stop the growth in greenhouse gas emissions, there is a limited amount of awareness. A lot of this research stemmed from the superannuation funds looking to buy infrastructure assets, wondering, well, if I invest in Brisbane Port or Brisbane Airport or wherever, some infrastructure asset on the coast, and I have a long-term liability of, say, 40 years for my pensioners, at that 40-year point, what are the risks that that airport will still be above water? What are the risks that that port won't be now closed because it's been bashed by storms for the last 40 years? And none of the super funds had an answer, and so they've been looking for this answer. But curiously, they're the only ones asking the question. Shareholders tend not to ask the question because they're only interested really in the shorter term returns. Insurers don't care. They get a 1-year policy, so they're not interested. It's really only the ones who have those long-term liabilities and are rewarded for mitigating it against any losses incurred in those long-term liabilities that this notion of adaptation becomes more real. Some companies have taken initial steps, and they're probably from the quarters you would least expect, but they are BHP Billiton and Rio and Shell. These are the big companies who've got the money, they've got spare capacity, they've got R&D departments, they've got rocket scientists that work for them. They can throw money at it and look at ways of solving some of these issues in both mitigation and adaptation. Carbon capture, sequestration, all the range of things, the big ticket items that we think about, that's what they're really good at and probably best able to deal with. Governments, less so. And so the problem was that, I guess another problem here is that the companies, the corporates are going to have to lead the way on this because the governments are unlikely to do so, right? Relying on a dozen or 24, 25 different countries to agree on an action which will reduce the temperature of the earth, you're not going to get that. They can't agree on, duties imposed on cars and beef. It's hard enough getting that over the line, let alone some of this more difficult stuff. So it really is up to the companies themselves to lead the way and work out how to actually incorporate this and drive this adaptation behaviour. The trouble is they don't want to do it outside their existing economic constraints, their governance principles and what their shareholders demand, which is to maximise their shareholder wealth. So they have to do all this within the constraints that are presented to them. Companies are generally guilty, some of them are guilty of short memories. They have to deal with more stakeholders now than they ever did. In the past, they just had to deal with shareholders. Now they've got creditors, other stakeholders. Some companies need a social licence to operate. There's all these things going on now, right? And companies are struggling just to deal with that, let alone think about the broader picture. The executives and managers themselves are rewarded short-term incentives. And that's fine, that works in some regard, but in the regard of adaptation and intergenerational survival for some of these companies, the incentives aren't clearly aligned. Insurance policies are not going to save or derive the adaptation response because they're only short term. The reinsurers maybe look a bit longer term, but the property casualty insurers are very short term, 1 year probabilities of impact and loss, and that's all they're interested in. The existence of tax incentives and other incentives to drive adaptation is also missing, and that's probably a failure on the part of governments. But in effect, a lot of the companies really don't understand the extent of the risk itself. And of course, cultures in the past have looked at ways of of adapting and trying to project some intergenerational messaging, as in the case of memory stones, but often the message gets lost along the way. So before I started looking at adaptation and what the real issues are with regards to mitigation, I always just have a look at the brutal facts and say, okay, well, what are the actual facts that exist that we know about? There is this notion of net irradiance, and this is a commonly drawn diagram quoted endlessly in texts, where we're looking at anthropogenic radiative forcing. And so it's fairly clear that there is an RF, a combined RF growth of about 1.6 with an error bound on the lower end, 95% error bound on the lower end at 0.6 and on the higher bound at 0.4. And radiative forcing is measured in watts of RF per metre squared. So that indicates that the probability that it's going to be zero is fairly low. Okay, so there's probably a 2.5% chance at best that there is no anthropogenic RF growth in the atmosphere. And most of the companies, and particularly the ones I've worked for, readily accept this. There's no concern about that. Along with the APCSE projections for temperature growth and that sort of stuff. You sit around the boardroom of a large company like BHP Billiton or Shell or BP or someone or others, and they have no bones with that whatsoever. That's readily accepted and used in their planning. So there's no disagreement there from the corporate sector. Neither is there with some of these figures, which break down that radiative forcing and the growth in concentration in the atmosphere by gas. And they're quite precise measurements and fairly narrow error bounds, which indicates that that's a fairly precise outcome. Once again, evidence suggests, and the corporate sector generally accept, that that's a fairly tight bit of science, and there's really not much we can do about that. And then we look at the other growth. So okay, we'll look at global emissions in the absence of any global deal. It still seems that CO2 is the most important gas, the largest growth of which comes in energy. Okay, and so the largest consumers of energy of the world are burning coal like it's going out of fashion. The trouble is there's lots and lots of coal still in the ground, and it's easy to get to, and it's cheap. And that's the critical issue here that's driving most of this growth in CO2 production. That's the graph of emissions broken down by sector, but clearly power generation comprises the base load amount, while others are increasing as well, and others is all of them. It's all the rest of them, agriculture and deforestation and so on. When we break it down into developed versus developing countries, the growth in emissions is probably going to come from the developing countries themselves. The quickest way out of poverty for many developing countries is to give their populations access to reliable, cheap energy and running clean water, and that's it. Generally, they'll do the rest, so long as there's not civil war and other things going on. That's the view of most of the mining companies, that's the view of most of the oil and gas companies, that's the best way to pull these countries out of poverty. And unfortunately, the growth in those less developing or less developed countries is going to be at such a rate that it will overtake, and indeed in some cases already has overtaken the energy demand from the already developed countries. Breaking the costs down by generation type just reveals one way of looking at where the motivation is for energy production. And this is just energy production. It I guess, comprises about half of the greenhouse gas emissions that are being generated. So how do we motivate the right behaviour in the energy sector itself? Well, looking at this is for the countries that signed up to the Kyoto Agreement, ones who have or are able to impose a carbon price, and we see that imposing that carbon price, which is the orange line, or the darker box, sorry, the orangey box here, does induce some switching, and this assumes at about $25 a tonne US, that there is some switching between coal and gas and some growth or drive, at least motivation towards nuclear and wind. Note that nuclear is a tough one because it's not that clear what the costs are. We don't build nuclear reactors very much. I mean, the US hasn't built one since 1979, so it's hard to nail down costs of nuclear power production. Same with wind, because what are we talking about? Wind base load, wind peaking. It's a bit hard to nail down. But there is some drive with a carbon price, some drive towards other technologies, and particularly away from coal. When we take away that carbon price and position these same plants in China and India, where they're able to build the plants for much less, they're able to operate them for much less, and they have no carbon price, coal still is the king, and it will be forever, and that's just the way it is. And I'll go through a slide in a moment which kind of points to this fact that at the moment it's a little bit powerless to go against this trend, but coal definitely does swamp other technologies. And the worst kind of coal, this lignites, it's the brown coal, the stuff that's dug out in Victoria, is by far the cheapest, and is by far the most prevalently used in the growth regions of China and India. Now, some of the ultra supercritical and supercritical plants that have been built in China and India using Chinese technology, which is fantastic, I must admit, it's excellent. It's excellent efficiencies, or 50-55% efficiencies, but they're still burning large volumes of it and not capturing that CO2 in any meaningful way. There is some drive towards nuclear, but the renewables are the ones that lose out big time, just because there's not that economic incentive there for them to develop them in large scale. If we break it down, this was an interesting exercise we did it, in my past life, breaking it down into the growth in power production per person per day. And this is what we're interested in, to see, okay, is there any actual forecast in a decline in power usage by us individually, through energy saving means or whatever. And clearly there's not. There's a growth. I mean, we're using more and more energy. The more I guess the richer we get. We want 2 fridges or 3 fridges. The average house in 1975 had something like 16 appliances, and now it has about 48. So electrical appliances. So we're using all these things all the time, and we want bigger houses and heating and air conditioning on demand and so on. Whereas in the OECD countries, the growth in power production per person per day is growing, but it is off a much smaller base. Noticeably, coal is the largest proportion of that expected growth, and these are generally IE, International Energy Agency figures. Coal is the largest growth there, while it's fairly moderate in the OECD countries. And combining them together, we see the global power production still is increasing, and unfortunately the fossil fuels of coal, gas and oil will still consume the vast bulk of usage. And these are the countries that burn the most, like the US and China, etc., are the ones that will continue to dominate that growth. I think there's a statistic that all the air conditioners in the US consume more energy than all of Africa. So, that's that drive towards growth in I guess the comfortable OECD countries where energy is cheap is still much greater than the growth in the developing countries. These are the graphs. I'll just show you a set of graphs now that make the energy and mining companies sleep well, executives sleep well at night. And this is the growth, or the real GDP per capita profiles of several countries from 1965 to 2008. So the green line at the top is the USA. It starts at 1965 over to the on your left, and finishes at 2008 on your right. And that's the profile of real GDP per capita in terms of energy consumption through that time here. The interesting graphs here, though, are Korea and Taiwan, which, well, Taiwan's not there, it's in a grey line that's kind of disappeared here. But Korea is an interesting example because that pretty much projects the growth of a country from a developing status to developed status in a fairly short period of time, 30 odd years. The two lines down here are China and India. And if they follow that same projection with whatever, 25, 30 times the population, you can imagine the kind of energy demand and energy growth that's going to continue on through there. And it doesn't matter what commodity we're talking about. If it's steel, same thing. Aluminium, same thing. Copper, same thing. China, India. Oil, same thing. If it tracks this profile here, which is once again Taiwan, then that growth in consumption, in energy demand, will continue to be quite massive. And this is what, this is what makes Mackenzie and all the others sleep very well at night. In terms of the production of power, the forecast is for both India and China to continue to grow their production, and yes, they're growing their renewables. And you hear figures every now and then about renewables growth in China will be $50 billion this year, or in the next 10 years, whatever it is. Doesn't matter. Coal, there's about $1 trillion reserved for coal alone, new coal production, and it's going to swamp anything that the renewables are able to throw at it. If I just project where Australia's current production is annually against where China and India's is, we're down about here and about there relative to India and China respectively. So we're talking fairly large numbers, and it's a little bit hard to fathom. You drive around China and you see all the power plants and the coal stockpiles. It's impressive, but it's quite scary. Now, we look at coal and we see coal in our backyard here and we think, okay, well, that's a dirty thing, we should stop doing it. But we need to put it in context. In terms of global production and consumption, we consume about 5.5 to 6 billion tonnes of coal per annum. Half of that is in China, another billion is in the US. The EU consumes a lot. Japan, Korea, Taiwan, and a few of the other countries in the Asia Pacific consume a lot also. If we break it down into met coal, which is the stuff that's dug out of central Queensland, the seaborne market is about 200 million, of which central Queensland is about 120 million tonnes. Okay, so not very much. Same on the thermal coal side of things. The seaborne stuff, the stockpiles we see at Newcastle and up the coast of Queensland are tiny compared to the seaborne amount, which is also tiny compared to the total production and consumption globally. So that puts it in a little bit of context. And then there's the carbon price that we impose. We think, okay, well, let's impose a carbon price. That'll incentivise CCS, carbon capture sequestration, and also incentivise renewables. Curiously, about that price, the price that we thought at BHP Billiton was about $50 to $60 would be enough to drive us to research and develop fully into CCS technology, and that's about the same price as it would have taken to drive behaviour towards renewables as well. So it's a close-cut thing. It'll be between one of those two technologies we always thought would be the winner, and whoever could generate that technology first in a scalable amount would be the ultimate winner. But pricing it at $20 or whatever we did just wasn't enough to do anything. It wasn't low enough to sort of, tick the box, but it wasn't high enough to actually do any damage in the energy sector either. So that was the problem. And coal ends up being in this no man's land. So if you have a carbon price which is in the middle somewhere, if we have a high carbon price and CCS is a viable technology, then coal becomes great. Unless gas prices plummet, which they're starting to, then you're switching into gas. In the mid-range, it's a bit hard to tell. It could be anything. It could be coal, it could be gas, and that's what happens. And that's what happens in the EU. Yes, they have an emissions trading scheme, but all that it does is just encourage a bit of switching between coal and gas, and the energy producers take the profits. So it doesn't do a lot. And at low carbon prices, coal still wins. And in countries where there's no carbon price, coal will be king. And that's the unfortunate thing that is driving the behaviour towards this. So they're the brutal facts, and that's what is kind of shining through at the moment. That's what the corporates have to sort of contend with when they're going about their decision processes. Now, in terms of detecting climate signals and that sort of stuff, this is where the corporates start to work out, okay, well, where's the loss on my balance sheet? Where am I getting a hit, and when do I have to take into account, you know, any losses that may occur? So if we look at it, first of all, from fatalities, these are the fatalities from natural perils over the last 110 years. And there is a general, you'd say, maybe an increase, you know, towards the end, certainly greater frequency of larger events. But when it's normalised by population, the graph doesn't look so scary. That's fatalities. It's a bit controversial, but if we look at it in terms of just insured loss, you see clearly that losses are growing, and we see that all the time, the biggest hurricane losses ever, and that'll continue to dominate the news, you know, year after year. It's like saying the banks are making more money now than they ever did. Of course they are. They've got more assets deployed, right? It's growing. If it's going to grow, of course they're going to make more money each year, okay? Makes sense. If they're not making more money, you have to ask the question, why not? So the insured losses are increasing, that's true, but when normalised by population and by the fact that we're building on the coast, more expensive homes, more expensive factories, etc., then if we normalise those losses, then it doesn't, once again, look so scary. And the climate signal disappears. So from a corporate perspective, they look at that and go, okay, well, that's just yearly loss. I can take an expected value of that because it looks fairly normal, and I'll just, you know, take that expected value and insure against that. The insurers don't care because, you know, they can't detect a signal in there, and it's unlikely, and this is research that was published through an NCARF last year, it's unlikely that a climate signal as such will come through in the insured losses for another at least decades, perhaps 200 years. So just to detect that increase in growth, because we're putting ourselves in harm's way, building factories on the coast, we're reclaiming land, building ports. Okay, if you put yourself in harm's way, the damage, of course, is likely to increase. So from that perspective, adaptation kind of gets lost. And climate change, therefore, is not of primary concern to the insurance industry. It's the accumulation of wealth in disaster-prone areas that will be the most important driver of future economic disaster damage from the insurer's perspective. So their motivation at present is fairly small. Now, there's several adaptation measures that companies go through, and their boards are charged with going through these and understanding what they mean. And of course, there's the social one, the main one, which is just to share the losses, just don't do anything and hope the government picks up the tab. But then there's a whole bunch of other corporate costs as well. You can bear the losses, modify the threats somehow, build a seawall or a levee. You can prevent the effects somehow. I don't know, putting air conditioning in to stop, you know, the workers dying on hot days. You can change use. You can just look at different, you know, uses for your technologies. You can move. That's expensive. Or you can look at research. Look, this is all well known, and the companies know all this stuff already. Okay, they already know that there's a need to adapt. We've got some risk. How do we actually, you know, go about it? Right? They don't know how to actually go about it. They're not incentivised, and rarely are they, you know, told through legislation that they have to. So they do need advice, and that advice has to come from somewhere, and it only can come from within. In my view, it won't come from main governments. So, as a practical example, we looked at BHP expanding one of our ports, and it's a coal port, but you know, just forget that for the moment. It's a met coal port, so it's not used for energy production. It's used for making steel, which is useful. But we had a conveyor belt, so it's at the top there. It's right at the top is the conveyor. Anyway, it was built in the 60s. It was quite, you know, quite low to the water. And every year it would get wiped out by storm surges for 30 days, 20 to 30 days every year. Stop production, well, not stop production, but stop, you know, transporting the coal onto the vessels. So that's an identifiable loss. We could then go, okay, well, we're losing 30 days of production every year. How much does that cost? At $300 a tonne, you know, I can nail down a figure. And if that comes out at a greater amount than it costs to replace the wharf, then happy days. Let's go and replace the wharf and go about this adaptation activity. And so that's what we did. And that's just a simple, there was no hoo-ha about it. There's no, you know, formal adaptation committee sat down and thought we have to, you know, tackle adaptation. It's just a simple practical response to a known problem that was likely to increase. Luckily, it's in a company that accepts the science and was happy to work with climate scientists and use the information that's already published. But you know, if you're going to expand a port for 100 years, it has to be able to withstand the potential for that 100-year loss. But the trouble is, it costs more to build a higher port, right? A bigger port with sea walls. And so the shareholders then say, well, what about the return on assets? You're not earning return on assets for the whole time that these assets are lying idle, essentially. You've got a really, really high conveyor, and it's not being used for 330 days of the year, essentially, and we're paying for that. So you have to demonstrate that somehow in the form of, on your balance sheet, in your, net profits and so on. But the trouble is you can't, because the money's spent. It's been turned into idle capital. You can't take off insurance from your expenses for the year because they probably weren't there in the first place. So what do? How do you get it through to shareholders that this is a worthwhile thing to do? And those are the questions that the companies are asking. What if we just finance the whole thing privately at some cost of capital? The funders, the financiers of that are going to say, well, why are you building, why are you over-engineering this port? You're gold-plating it. You don't actually need to build something that's, that's able to withstand a 1 in 1,000-year storm, when a 1 in 100 year will be fine. Can we just insure the assets? How do we just insure the asset year after year and just hope for the best? And then there's all those other questions that start to impact on the board. How do we govern it? How do we build it at an adaptive capacity and disclose it to our investors in a way that makes sense, that we can justify? In form of economic capital, Fisher Black and his colleague of his, Perrold, came up with a view of looking at capital in a sense from a banker's perspective, to say, okay, so if I'm going to finance a company that is diversified, can generally take on more assets or more operations at a lower cost of capital than one that just operates a single business. So think of, say, Wesfarmers, a holding company essentially with multiple businesses. Until the other day, insurance was one of them, so they sold the insurance business off. But acquiring more and more businesses into that company allows you to diversify, and it lowers that cost of capital through time. However, most investors don't view it that way. They view every single asset on its own merits. Okay, and that's the trouble that most of the companies are up against with climate adaptation, is by saying, okay, if we're going to add an asset in, if we're going to reinforce the port, build a seawall, if we're going to move away from the coast or put air conditioning in or whatever, how does that actually translate onto our cost of capital? So if I have two businesses, I have business A and business B. A is really profitable, but B isn't. It might just be an incremental thing that we'll get some protection from, be it some sort of climate change adaptation activity. The standalone risk capital that a bank would charge against those two things perhaps is exactly the same. When you combine them together, multiply by the square root of 2, then that reduces a little bit because you've now got a diversified business. The return on capital is where it starts to get a bit tricky. What's the actual return that we're earning here? So for A, it's fairly easy. It's $30 against a standalone risk capital of $100, so we're earning 30%. But for asset B, it's only 10%. So you look at that and you go, well, that asset's a dog, I won't do it. But it's adaptation. It may save us in those dark years in the future where we're trying to stay profitable while our competitors have gone out of business. So if we then look at the return on capital, when we allocate the risk capital equally between those two assets, then it starts to look a little better. It goes up to 14%, and if we view it in terms of marginal risk capital, it goes up to 24%. And that's the kind of messaging, the kind of capital allocation that we're trying to get through to many of the corporates, taking on diversified assets. And this assumes that A and B are not correlated at all, and B shouldn't be if it's an adaptation asset, should have nothing to do with the profits of A. Then diversification does create capital. And even when we view it from a pure economic perspective, when we're taking into account, say, some sort of cost of risk capital. So if it costs me 20% to borrow this money, or if the bank is going to attribute a 20% risk against that capital, if it loans it to me, then there's going to be some deadweight loss in there. So that's the loss that's just sitting on someone's balance sheet not being used. The profit after deadweight loss for A would be, say, $10, but for B, it's clearly a loss. But when you add the two together, you're still getting an incremental change here of $2. So you would undertake that investment because it does create value. If the profits of A were to decline, then you'd look at that and you go, well, I won't invest in either business, I wouldn't bother. But you're still creating some sort of value through that diversification in an adaptation asset. So it can't be viewed as a standalone investment, as most companies currently do. It has to be viewed in the total perspective of the corporate's activities. And that's the trouble with the banking sector at the moment. The banking sector looks at the top picture and says, okay, that's how I'm allocating capital. And I'll judge you on the return on capital and not the return on marginal capital. What we did also in the, what I did, okay, so also in the book was to look at, say, what happens, what is the likely outcome of companies who choose to adapt against those who actively choose not to adapt, and let's see what happens. So I put it in the context of, you know, a funny model that we use in finance called the capital asset pricing model. It's a single index model where we say the return on an asset should equal some sort of risk-free rate of return, and an asset being a company's stock price over time, should be equal to some risk-free rate of return, call it the long-term government bond rate, plus some fudge factor based on the riskiness of the company and the premium in the market, the equity risk premium in the market. And there'll be an error term that's associated with that. It's only about 50% accurate, so it's not great. R-squareds of around 50%, but it's okay for government work. And we just did a quick analysis on what we would think would happen. We hypothesised that perhaps all companies generally, theoretically, should lie on this line somewhere here. So if you're a company with no risk, then you'll earn some sort of positive return at the risk-free rate, and the risk being 0 with beta. And the beta at 1 gives you a market, the market rate of return, which is the expected return on the market there. We hypothesised that if you're situated on the line and you choose to adapt, then there's every chance that your returns may exceed your level of risk, and therefore your share price would be, you know, underpriced, and then it would rally. In the opposite direction, we thought the same thing would happen. Companies that choose not to adapt would increase their risk and possibly decrease return. So we had to try and work out some way of picking companies that would you know, behave well enough for us to do this in. So what we did was we chose the energy producing companies in the EU, knowing full well that they had about 6 or 7 years to prepare for the introduction of the cap and trade scheme in 2005. And we looked at the companies that adapted by diversifying away from fossil fuel dominated production technologies into other technologies, and firms that didn't. And we called the first lot the adapters and the second lot the non-adapters, and just saw what happened over about the 1999 to 2011 period. And we found that the companies that adapted lost return. That's true. They went from here down to here, but their risk decreased. The companies that chose not to adapt for various reasons also went down in return, but their risk increased dramatically. So in both cases, the return declined quite significantly, but only for the non-adapters did their risk increase significantly. So they're the results there. I won't dwell on those, but note that they're okay. And I guess just taking an example, NL is an Italian business. It had just fossil fuel companies, and then prior to 2000, and then started to look at diversifying into other sources of generation. And now 40% of their power is generated by nuclear and hydro. They got heavily into hydro and other forms of production technology. So for this company, fairly stodgy, boring energy company, managed to turn itself around, adapt, knowing full well that it could take advantage of the emissions trading scheme and avoid the liabilities associated with that. Its average annual return declined, that's true, but so did its volatility didn't increase as much as, say, Drax, which is a UK-based power company, one big, massive power plant, 4 megawatts, produces about 7% of the energy in the UK. It had great annual returns, which then went severely negative. But importantly, its volatility spiked to crazy levels, and especially to such a level that investors were no longer interested in investing in the Drax company, because it's got a single asset. And the trouble is with Drax, I guess, they realised they couldn't diversify. They had no spare capital on their balance sheet to diversify into. There's nothing they could do, so they were stuck. And so it's a clear indication that, I guess, non-adapters will suffer the consequences of increased volatility in earnings, as opposed to loss in returns, because everyone will suffer loss in returns through the adaptation process. Now, the effect of adaptive capacity on the balance sheet is of interest to most companies. And so when we're looking at short-term horizons, it's easy to self-insure, it's easy to just insure, maybe borrow more money, and look at other ways of protecting against losses. When you're looking at far longer dated horizon losses, recapitalisation, external support are clearly required because the loss severities are fairly great. And this is a great concern to most companies. What we did is came up with a way of allowing companies to assess their loss depending on the number of adaptation objectives they had, as well as the impact or the measurability, the quality of the measurability available to them. If you've got good numbers, you've got good analysis, good data, you can employ things like cost-benefit analysis and expected loss assessments to work out exactly the expected losses and therefore what the adaptation response could be, and then just do your numbers. Is it more costly to adapt or not? If it is, then don't adapt. I mean, that's an active choice that the companies then can take, and they go, well, we'll take the risk. The trouble is when they make that decision, there's no statement anywhere on the company's annual report to say we've actually decided not to adapt because we've found that it's too expensive. When you get lower levels of measurability or quality, then you've got to go with other more fuzzy decision metrics, things like cost effectiveness and multi-criteria analysis and that sort of stuff. And that's more the larger scale coastal, island state analyses that gets done. And then the trouble on top of that is the accounting treatment of the asset that you've just implemented. You build an asset, it has a base cost, you assess it against fair value, but then you allow for some contingency, that's fine. But if you've over-engineered this asset to say 30 years, 70 or 100 years, then immediately, and in many cases, sometimes you have to impair that asset straight away. I built a port for $1 billion, it's really only worth 800 million, I have to impair it on my balance sheet straight up. And investors get a bit scared when you start doing that often. I guess I'll just go through impairment fairly briefly, but there are some curious incentives for companies to impair, to look to adapt, because the impairment doesn't come out so bad. So under the US laws, under the US accounting treatment, an impairment loss is only required when the undiscounted sum of all your future cash flows, so you add up all your future cash flows and then look at the value and then compare that to the asset's book value. You only have to impair that asset if the sum of all those undiscounted cash flows is less than its current book value. And then if it is, you have to impair it by the amount of the difference between the book value and its fair value. But the fair value won't equal the sum of all the undiscounted future cash flows. So you get this silly situation here where the future cash flows will look like that, and this is your asset getting older and older through time. At this point here, the discounted future cash flows cross the book value, but nothing happens until you get to this point here, and then you go, okay, well the best knowledge I've got of what this asset is truly worth is its discounted future cash flows. So I'm tracking along, my asset's worth $8 million, I get to this point, I have to impair it immediately down to about $4 or $5 million at that point, and then impair it every year from then on till the day it dies. That's the current situation with assets without any adaptive capacity. If I have adaptive capacity, all that means is I've now built this asset which is much larger, more expensive, and it just starts to shift this whole thing to the right. So instead of having an $8 million asset, I've now got a $10 million asset. The fair value is never greater than its book value, so it's already, losing money, essentially, on the balance sheet, but you never actually account for it until this point here, and that's when the impairment loss takes place. So previous we were about 18 years, now we're at 22. If I have another asset that I've, adapted, I've over-engineered to buggery, I've built 5 desal plants next to the asset and stuck them all on there, you don't actually have to, under the American scheme, impair that asset until almost the day it dies, and it's never worth more than its cost. And the same thing happens also with an asset that is like just a seawall or an insurance asset of some sort, some sort of self-insurance where the discounted cash flows are probably going to be zero because all you'll end up doing is preventing loss rather than making money. So there'll be some residual value here in that discounted scheme, but you don't actually have to impair this asset for 20 years, which is curious. And it's a curious kind of motivation for companies in the US to look to adapt because you can take advantage of some of the crazy accounting rules that occur. So they'll be impaired later in their lives despite the fact their fair value is represented as the sum of the future discounted cash flows, and they may never exceed that carrying amount. And it can offer advantages to firms when planning to develop new assets because, that will allow them, and whether you call it climate change or just future weather risk, it shouldn't matter. It's still the same risk that the company bears. In the book, we discuss a disclosure framework for investors, and this is what's missing. There's a lot of pages in annual reports on mitigation and how we're preventing greenhouse gases from entering the atmosphere and that sort of stuff. There's very little on adaptation. The CDP, the Carbon Disclosure Project, asks a few questions about adaptation and how you're building that into your business, but nothing as specific, and certainly nothing near what the mitigant fraternity look at. So we built a way of looking at the level of vulnerability, measuring the adaptation response to that. How do you disclose that to investors in a framework that kind of builds off the ASX's ethical principles, which is, if not, why not? If you've got this risk, why don't you disclose it? And make that a little more, certain for boards and executives to enforce. And then going back to their risk assessment and just continuing that circle, around and around. We proposed a governance structure, and this is just the governance structure for a large mining company. So big board of directors and lots of committees at the top with some assurance that feeds in through the side. But there's definitely a set of policies, committees and standards and procedures that are developed from that. But what we're trying to advertise is that the adaptation response doesn't have to be a standalone unit that operates on itself, that cuts through everything. It can actually be incorporated quite easily into all of these standards, policies, procedures and governance principles that most companies already engage in. And some shameless promotion, that's the book. That's what we look to cover. And initially it looked at helping investors understand what their disclosure was, but clearly there was a gap for companies to understand what that level of the loss and so on that they're likely to face in the future is as well. And importantly, the need for case studies is critical, and there are companies out there who've performed excellent climate change adaptation responses. Some of them are in Australia, and world-leading, really excellent analysis that is I sort of refer to in the book and try and bring to life a little more for companies looking to mimic or apply that. And that's it. Thank you for listening. Any questions?